bold one. So we're just going to copy this, click the link, paste that same link in here and update it. So then we can get rid of the rest of this information. Something important to note here is that they don't actually have to click the subscription preferences. If they open this email, then they're going to be removed from the unengaged 120, which is really nice for us, and then go right back into our engaged 90. So this is all good here. Again, we just want to check and make sure that everything's spelled correctly. We can click exit. Then we want to update the subject line again from ChatGPT, post that into the subject line, and then we can just add a little preview text as well. Then we just click done. And then we're going to go through and do the same exact thing for each email in the sunset flow. Again, we want to use that 120 unengaged list, but we're just going to copy and paste all this information from the templates back into the GPT so it updates for our brand, and then change all that information in the flow. We can have discount codes. I would just follow the templates exactly, update the triggers so that they make sense. Again, follow the template for the time delays. We're going to change this to 5 days. And for every flow that you have, super important, make sure that you have skip recent email profiles turned off for every single flow. It's extremely important we have that turned off. Then we're just going to make this live. And again, we'll do this for every single email in the series. Lastly, what you can do is delete this profile property update. Again, if anyone opens any of the emails in this flow, they're going to get sent back into the engaged 90. So we don't have to worry about that. So we can click exit. Then we'll go back to our audience, go to lists and segments. And this is important too, to keep your costs down on your unengaged list. So once a month, all you can do is go over to these three dots, and then we can click suppress current members. And what this does is it saves all of their information, but it doesn't count as an email in your profile. So it lowers the total amount of emails in your Klaviyo account, which is super nice because it saves us money in the long term. So I go ahead and do this once a month just to clean up the list a little bit and save myself a little bit of money. Okay, now that we've created the example of the campaign email, who do we send these emails to? And we want to send them to our 90-day engaged list because this keeps our deliverability rate high while also letting us remove people who are no longer interested in our brands. And I want to show you quickly how easy it is to set up segments inside Klaviyo. All right, so right now I'm going to show you how to use segments in Klaviyo when it comes to emailing our customers. We're going to go to audience, and then we'll go to lists and segments. And for a majority of our emails, we're going to use the engage 90. And it's nice that Klaviyo sets up the engage 90, engage 60, and engage 30 days for us already. So we don't have to do anything there. The only time we're ever going to email our entire list is during huge sales like Black Friday and Cyber Monday. So with that being said, let's go over and create our first segment here. So we'll go to create in the top right hand corner, click create segment, and we're going to do the sunset flow here. So it'll be unengaged 120, which means the last 120 days. And then we'll go to select a condition, and we will click what someone has done or not done, and we will go to open email 0 times in the last, and then we want to make sure that we change this to 120 days. And again, we're going to use this for our sunset flow, and then we just click create segment, and it will create that segment for us. So super easy, and you can use this anytime you want to create a segment inside of Klaviyo if you want to email specific people. And yeah, super easy. And you might be wondering, when do we send emails to our entire list? And that's a great question. And we only do it during major shopping times like Black Friday and Cyber Monday. They're special occasions and not typically how we send our campaigns. So let's discuss our campaign schedule for the rest of the year. And for this example, it's just one campaign a week. Sloth Hiking Club is currently sending 3 email campaigns a week. But for this example, I'm just going to show you what it would look like to have one campaign a week. Just beginning and starting out, one campaign per week is fine. And it might look something like this. So week one is branded content. Maybe it's a specific story behind a design. And then in week two, we send a discount or new designs added email. And we want to alternate between value and offers. So that content style email and those sales kind of emails. We want to keep it consistent. And you might be thinking, okay, so what kind of metrics am I tracking that pairs with my emails? And that's a great question. And we have our email KPI targets right here, which is open rate, submit rate, click rate, subscribe rate, and unsubscribe rate. And we have a nice little email metrics cheat sheet here that you can use for all of the metrics you need to be tracking, along with benchmarks and why it matters as well. And with that being said, I'm going to show you inside of Sloth Hiking Club's Klaviyo account so we can look at all the different metrics and where to find them right now. Okay, so this is the inside of Sloth Hiking Club's Klaviyo account, and just quickly want to show you some important information. Now, if we take a look here at attributed revenue of campaigns and flows, it just shows the overall importance of each. Now, the campaigns are those one off sends, and they've generated over $45,000 in email revenue. And the flows are the money makers and why they're so important to set up for your brand, where it's almost done double the amount of revenue, 45,000 versus 87,000. And you can see the percentage breakdown in the revenue coming in. The flows have generated almost 66% of all of my email revenue versus just the one off sending campaigns. And remember, the flows are automatic. Once we set them up once, they just continuously run, which is great for us. Then we can go and check the top performing flows, and I have pretty much all of the same flows set up for Sloth Hiking Club as what you'll be seeing in a second when it comes to all of the flow creations for our brands. You can see I have the welcome series, abandoned browse, abandoned cart, abandoned checkout, post purchase, and abandoned site as well. And these are all super important to set up. And again, we'll show you how to set these up in a second, but this is great. This is all automatic revenue coming in for me that I set up one time and then don't have to do ever again. If we go to the dashboard here and go to business review, we can see the attributed revenue from email for Sloth Hiking Club. Very important to note here, I didn't set up email until July. I had almost generated $400,000 in sales before I set up email. You do not want to do that. That's a massive mistake that I made for the brand. I was late to the email game and also just overall general laziness when it came to setting up email for Sloth Hiking Club. If I would have set this up in the beginning, as soon as I started bringing customers to my website, there would have been way more revenue from emails. So definitely don't skip out on setting it up from the beginning. It's super important. As you can see here, look at all this email revenue that came after I set it up. I could have had all that during these other months as well, but I just chose not to do so. So definitely set it up. It's super important. And then in here, we can also see all of the breakdowns by campaign performance summary. We can just see this incremental growth that happened. Again, I didn't set it up for all these months prior, but then finally found the time to set it up. And then you can see the flow performance as well, deliverability, which is super important. We want our deliverability to be high, along with some industry benchmarks as well. Not all of these are going to be excellent. Fair is okay. Obviously, I need to work on the spam complaint rate a little bit, but that's primarily down to Black Friday and Cyber Monday, where I was sending my customers a lot of emails. So this is just a quick breakdown of the metrics inside of Klaviyo for Sloth Hiking Club, so you have a better understanding of what it looks like. Okay, now that we've saw the inside of Sloth Hiking Club's Klaviyo account, we're going to talk more about this in the scaling roadmap section of the course. Let's talk about what you've accomplished so far. You've set up the ability to follow up with your customers basically for free. Your pop-up is live. The welcome flow is sending right now, and you're capturing emails from every visitor, turning them into customers on autopilot. And we'll cover email campaign scheduling later on, but for now, we'll just let the pop-up capture and the email flows generate. So here's what we need to understand next about scaling. Catalog ads are great for discovery, but they don't scale as well. Why? Because Facebook is a social media platform, and right now we have the media going out. Now we need to gather the social piece, and the social piece includes comments, likes, and shares on our ads, which is commonly referred to as viral ads. And this pours rocket fuel on our ads to start compounding. Now, with that being said, let's go ahead and create some viral content.
Here's just a small taste of the kind of engagement we are able to drive when we create static ads that we set up to turn into viral ads through our ad account. So here's just one ad that we created that generated 2,200 likes, 116 comments, and 133 shares. Now, that is just a tiny taste of the power that one of these ads can have for your brand. Before we set up these ads, and we're about to set up these ads on your brand, and we're going to walk through how to pick which products we should turn into them and how we weave them into our overall marketing strategy. But first, let's answer the basic question. What is a static ad and how is it different than a catalog ad? It's honestly exactly what we set up earlier for the mock-up test. The question is, like, why do we make them? When I say it's exactly the same as mock-up test, I mean that it's the same structure. We're not testing the mock-up again, but the buttons that we clicked and the way that we set up that ad set and then we uploaded the individual picture, that is all that a static ad is. And the reason that we make them is because catalog ads are meant to discover and static ads are meant to scale. And you can think of it like a say there's a new Chinese restaurant that just opened up around the street, around the corner from you, and nobody's in line. Nobody's inside. And as you walk by, you're like, "Oh, should we take a look?" Then you see, "Ooh, it's a ghost town." Nobody wants to be the first person to try out the new place, unless maybe you're a foodie or something. But opposed to if you go walking by that same restaurant, same opening night, and instead you see a line that is wrapped around the block. People are packed wall to wall. There's a wait list a mile long in order to just get a table. Which scenario, same exact restaurant, which one are you going to walk into? Yeah, you don't want to go into that one at all. And the psychological effect that line has on us is it makes us curious. Like, what is it that people are talking about? We are social creatures. That's why seeing reviews, 82% of consumers trust online ratings and reviews as much as or more than recommendations from family or friends. That's powerful. That's just how our brain is wired. It causes us, without even knowing anything about the restaurant, to assume that it's good. And that's how engagement works. And we are advertising on a social network. This is literally exactly what it is built for. You can think of it as like your catalog ad is going out and prospecting for recruits for like a baseball team, and it's having tryouts and it's pitting all of the best players and all of the new coming players against each other. And it's helping to find who are the players that are destined for the big leagues. And then the static ads is where we test out if they're ready for the big leagues. Now, as we all know, sometimes when people get called up, it goes really well, and other times it doesn't. And the team manager just simply learns from that. So, dropping the metaphor, that's exactly what we're doing. We are using the catalog ad to prospect and rapidly try out all of our designs. And then the ones that we want to really spotlight, or another version of this is think of it as you're having an audition through your catalog. And then out of the audition, you take the best musicians, and those are the ones that get to go on concert tour. Two different ways of looking at it. Point is, catalog tests, static ads is where we bring them up so that they get more distribution. And the way that we identify the stars for our tour or players we're going to call up to the big leagues is we simply look at the past 7 days of catalog data, which at this point, our catalog should be running all the time. It should not be getting turned off. We should be hovering around a 2.0 ROAS. That's why we're looking at past 7 days instead of just saying like this past weekend. And what we're looking for are any designs that are getting purchases, any designs that are getting consistently less than $1 cost per clicks. And then we also make a note of which color is performing the best. And then I make a new campaign and call it static ad test with, again, a $12.50 a day budget. And I simply run it just in tandem with the catalog ad test. And we're going to put 5 designs in the ad set. And here, even though the catalog is going to be running all the time, here we're going to be running these again from Thursday to Sunday because we're just testing them out in the big leagues. And then we're going to quickly cut any of the players that are not making it. And we're just going to continue moving forward with the winners. Now, let's go find our stars. The way we analyze the design test results, this should feel familiar. We go to our design campaign, go to the ad set, then go to the ad. You click breakdown, delivery, product ID, and the results are now broken down by design. And then you sort by amount spent and find the designs with less than $1 cost per click. Now, the piece that we're adding on is we are also looking for designs now that have gotten purchases. So now I'm going to build out our static ads, picking out 5 winners, show you how I'm going to build them, set the budgets, and then we're going to come back and you're going to do it yourself. And we're going to be looking at our other 7 figure brand from the past 7 days, looking at our catalog, for example. I would love to be doing this with Slice Club data, but yeah, we just don't have enough time to. We would have to run it for 3 to 4 weeks in order to get it. Maybe if you're interested in that, then comment down below. Maybe I'll post it as a series, like in the free community or something. Anyways, so we're looking at this, and this is plenty of data to go off of anyway. So this is our catalog that over the past 7 days has spent $1,900 and 3,000 link clicks, 64 cents cost per click, 120 purchases, and 2.8. So that's a solid amount of data. Even if you're just looking at this much data, you can still, meaning like 300 bucks spent, 12 purchases, 1.8. This would honestly be pretty realistic for like a week of spend, if not worse results, but a week of spend right now for a catalog. But notice how, we say it's for prospecting just because what it's best at or better than anybody else being the other campaigns, doesn't mean it doesn't still pull its own when it comes to getting sales. It's dual purpose. So, anyway, last 7 days, let's look at breakdown, product ID. So now that we have the breakdown, we sort by link clicks, and you might notice here that it doesn't have any purchase data. But we said earlier that we're basing this off of designs that have link clicks and are getting purchases. And what gives? Where do we find the purchases? We get that from Shopify. So we are looking here at just what's getting the cheapest clicks. And then we look in Shopify and we have essentially 2 lists to work off of. So scrolling down the list here, the things that immediately stand out to me is one, this one got a ton of link clicks, but it was pretty expensive. So I'm hoping that Facebook was getting a good conversion rate. But then all of these right here, these are awesome stats. This one's good. Yeah, there's a bunch in here. Now, again, this is us spending a decent amount more. So more realistic is like something like this, where, yeah, this is good. So 80 link clicks at $2.24, 56 at 81. So this one I'm just leaving out because it's super, yeah, it got a lot of link clicks, but it's really expensive. But then going down to about here, I see a good list of designs that we could turn into statics. So again, we're just looking for designs that stand out from the bunch, and then we turn them into static ads. So now let's go take a look to see sales examples. Let's go take a look at Sloth. Yeah, so for Sloth, we go to total sales by product. So we look at past 7 days for link clicks, or you can also look at past 30 if it's not enough data. But then for sales, we normally just go with like the widest time range, and then I might look at past 7, but I want to see as much data as I can. And so we can see this is in June. The Out of Breath shirt was doing really well, Sunrise Pines, and Stump of Life t shirt. So now, if this design is getting all of these conversions just from the catalog ad, meaning every time somebody is seeing it, it looks like it hasn't been touched before. There's no engagement. So if it's getting this many sales from just the catalog, how many more sales do we think it would get if it was able to go on tour by itself and rack up all that engagement and basically have a line around the block? How many more people would that pique their interest? That's what we're here to find out. So, say we combining the 2 examples, if this was Slice, we would find, okay, what design is this? What design is this? What design is that? And then I would grab this one, and this one. So that's how we would look at the cost per link click data and the sales data from Shopify. And then we create the ads. So at this point, your design test should be running all the time. And now we're going to create a additional ad. And actually, the fastest way to do this, if you want a little hack, these are the super cool orange glasses ad hacks. This is what cool looks like. All right. So instead of creating all of them again, one by one, we can just select the ads that we want to use. And then actually, we could even do the ad set. Heck, why not the whole campaign? Let's do it. So duplicate, duplicate. Great. Now we just have a bunch of, this is why not. Static ad or test. Advantage plus catalog budget, leave it off. Or catalog ads, ad set budget. Do. There we go. $12.50 budget. Placements everywhere. Nice. And now here, what's the first thing we're going to do with these? How do we keep our life nice and organized? Keep things simple. If you guessed change the name, you are correct. Now there are three different ways we can change the name. Getting more familiar with the ad account. We could click here and edit it there. We could click that and edit it here. Or we can go like this and then use the bulk actions here. Everything in here is just a bulk action for something you can do somewhere else. Fun fact. It looks like a totally different like set of tools, but it's all like media. That's just changing the image. Primary text, that's updating the ad copy. That's turning off the annoying checkbox we always turn off. Advantage plus creative, like that's the other fun stuff we turn off. So fun stuff. Now let's change the name. And we're going to name this static ad number. 1, 2, 3, 4, 5. Save the draft. Then click edit. Then, assuming that we don't have to change our ad copy, which basically your ad copy is not a problem if you have made it this far. And pretty much as long as you follow these best practices that we talked about, then your ad copy will never really be an issue. But what we do want to do is change each ad's media. So we're going to come here and I would use the color that this variant is. So you get the number from there, and then you go into your Shopify store and you search that number, and it'll show you the exact color that's getting the most clicks. Because keep in mind, this is testing all the variants. So it could be our Bad Lie shirt, and we think the best color is, white. Like I thought it looked pretty good, but it turns out that the one that's getting all the clicks is the navy. So we want to make sure that we grab the right color, and then we would upload them in here, and then you just let's go with mockup 6, 8, 9, 10. Continue. There we go. And then the one thing that I want to make sure is off. Yeah, turn off the end date. At this stage, I don't use I never use scheduling. I just control it myself. But when we're launching our first campaign, it can be helpful in terms of ease of mind. Yeah, now we have our static ad set next to our catalog ad. And as a side note, you can feel free to rename these to whatever you like. You can even, for bonus points, you can pin your favorite campaign. There you go. Lots of fun stuff here side of Meta Adland. Then you just click publish. Show me an error. I dare you. Oh, you showed me a grayed out publish button. That's just as good. Try again. All right. Refresh. Nope. There we go. And if your ad account ever really glitches, you can do this. This is like you're when you're really pissed off at your laptop and you just like jam down the power button. That's like doing that to your whole ad account. So I've only had to use it like once in past couple years. Like if something gets really stuck and I can't like if it keeps saying review and publish, but there's nothing to publish, that kind of thing. But that rarely happens. So we now have our static ad test set up, 5 ads in the ad set. So to recap our spend, our catalog ad, once it starts running at a 2x ROAS, we have now left it running. And keep in mind that fluctuations like 30 to 40% day to day are completely normal in terms of your cost per click, number of purchases. We're looking at the 7-day average. So that's now running all the time. And the static ads that we just launched have a $12.50 a day budget as well. So these 3 campaigns, and the mockup test is now turned off, are pretty much the only ones you need to run. You have 3 campaigns: catalog ad, static ad, and then your email flows. So we have the catalog ad that finds the winners. Static ads are testing to build up engagement. And in the scaling roadmap, we are going to be talking about what we do with these winners. Like when we run it, say now it's Monday, what do we do with the static ads? That's what we're going to be answering next. But the question that I had at this stage primarily was, so I have all these different pieces. I know I can send emails and I have some flows set up and I have ads running and I make some designs, but what is the complete system? How do these all work together? Where should my focus be placed? And when and how do I scale up? And on the flip side, when do I cut? And how do I consistently grow and bring profitable days back to back to back inside my ad account? And ultimately scale from 3K to 5K to 10K per month. And without a clear scaling system and decision making framework to follow, students and myself included end up just making random decisions. So let's fix that right now. So, how do we bring consistency to the ad account to be able to scale up the budgets? Because right now we might be spending anywhere from $50 to $100 per day. And as long as we're spending at relatively low levels, we're always going to have very inconsistent results. We want to scale things up to get over the $1,000 to $2,000 per day mark as quickly as possible so we can really start to bring in consistent sales. Because until we get to that point, every say we have like 5 sales per day. If you miss one sale, it's a 20% drop. It's a pretty tough game to play. The good news is once we get over that, it's kind of like a boat when it's trying to get up on plane. As long as it's just, down in the water, it's feeling every single wave hitting against the bow until it gets escape velocity essentially. It gets going and it's up on plane, so it starts skipping across the waves. We're able to do basically the same thing with our ad account. The question is, what should we be tweaking? Where should we be placing our focus in order to get there? The first things first, we start off by reviewing the static ads and looking for any ads that were running at a profitable ROAS over the weekend test. And then we pull those out and we put them in a winning ad set. So the whole game here, just keep the tryout metaphor fresh in your mind. We are the coach. Our number one goal is to get the best team possible, even if that means recruiting endlessly. And we will never settle for a subpar player. Same thing goes for our ads. So we pull them into a winner ad set. So we're just testing and then pulling together the winners and letting them run together. And then launch more, pull them together, let them run. And then over time, it builds up and up until you have a really, really good group of ads. And when I say really good, I mean the kind of ads that are able to get hundreds and thousands of purchases at a 2.5 to a 3.0 ROAS without burning out. And as we are consolidating, we are then prepping more static ads to launch. Now, the question that might come up is, what do we do if when we looked at the catalog ad, there were none that were in the cost per click range that we're looking for? We just pick the ones that are doing the best, or we leave none of them running. And so we put them in the winning ad set. And at the same time, we were prepping more static ads to launch. What do we do if when we're reviewing our static ads, we see that none of them got purchases and they all got really expensive cost per clicks? That happens. It's entirely possible that your best performing design that was getting lots of clicks in the catalog will not get any clicks in, not any, but it won't perform to the same level in static ads. So that's just the nature of the game. The good news, there's no cost to us uploading another 100 designs. The only cost of that is being willing to set aside our expectations, our unfounded expectations of how fast this should or shouldn't happen and how many designs it should or shouldn't take. The sooner we can set that aside and just lock into the process, the faster we're going to get there. So if it's underperforming, then we just pick the ones that are doing the best, or we can leave none of them running. But we just keep rinsing and repeating. Okay, and for all of us visual learners out there, this one is for us because this is a visual breakdown, the simplest possible way that we can cover this. Really make this click, hopefully, so that then you'll know exactly how to be moving around the static ads, exactly what we mean by making new ad sets. But first, as I was drawing this out, I realized, especially using the ad account the first time, it'd be really helpful if we add the word campaign to the campaigns. So I recommend now updating all your campaign names to be this. And this is what we're going to be referring to them as from now on. So we have the catalog ad test campaign, the static ad test campaign, and the mockup test campaign. And mockup test campaign, obviously, we're not using anymore. And then the ad sets, I recommend naming it catalog ad test ad set. That's a mouthful. And then the static ad test number one ad set, and then have the word ad in at the ad level. The reason being, it can be so easy, and I know this from personal experience, getting confused between am I at the ad level or ad set. Just having the word ad set there helps. Just one of those like little 1 degree tweaks that from looking over the shoulder, people working through their ad account for the first couple of times, it would help clarify some things. All right, so what we just described with graduating or with testing out the static ads, here right now is what our entire ad account looks like. All of the running campaigns, at least. The mockup test, obviously, we don't have to worry about anymore. So up top, we have the catalog ad test campaign. This is running at $12.50 per day. And as we talked about many times, this is testing all of the products that we are then able to see which ones are getting the cheapest clicks. And then from there, we then are doing two things. We are creating iterations of the winning designs. So making 3 to 5 iterations, remembering the 50-50 rule, 7 designs per day. That is, if you fall asleep and do nothing the rest of tonight, just wake up tomorrow thinking about making 7 designs per day. That is the only thing that matters. Everything else is literally just semantics. But we make 3 to 5 iterations off the winners. And now we have the added tool in our chest of turning them into static ads. So what that looks like is what we just did. We found the ones that have low link clicks. We looked at the ones that have sales, and then we made this ad set. So that's this campaign right here, one ad set, and then the 5 ads. And now we let that run for $12.50 a day, Thursday to Sunday. So it spends about $50 by the end of the day on Sunday. It might spend up to 60. Sometimes it goes over slightly, sometimes it underspends, but ballpark. So we don't have to be looking for the exact like line in the sand. And we try to, a lot of times with, especially with ads, I find people, and it makes sense, try to find like exact answers, like do exactly this. There's no absolutes in it. It's just learning the concepts. What we're trying to do at a high level is we found ads that we think are going to perform well, and then we put them on display to see if they perform even better. And then we're looking at on come Sunday night, Monday morning, we're looking to see did any of these ads get purchases, even 1 or 2 purchases on that little spend, because our average cost per purchase is about $19. So we're only at that budget, we're really only looking at 1, 2, maybe 3 purchases. So 1 or 2 purchases at that spend is perfectly good deal. So I would count that as a winner because it's almost definitely running at a 2.0 ROAS. On the flip side, we're also excited about ads that are getting really cheap cost per clicks. So if say our catalog ad, and it's relative to what you're seeing in your ad account. So say your catalog ad is getting 95 cent cost per clicks on average past 7 days, then you have a static ad that got 15 link clicks at 70 cents. That's also a good sign. But then anything that got like 0 purchases and $1 plus cost per click, then I just count that as a loser or lesson learned, and I just turn it off. And then what do we do with these up here? We just leave them running. That's it. We just leave them running. And then we look at the catalog ad again and see which ones do we want to turn into static ads next. And then we launch another 5 to 7. You can go up to 5 to 10. I wouldn't go over 15 ads in the ad set, especially at that low budget. But you just start adding in new ones, and every Monday you're looking for the same thing. Anything that got really cheap cost per clicks, ideally is getting purchases. And as you start getting more purchases, like it's not even close. Like if you have 2 ads that got 2 purchases at a 2.5 ROAS, those are the winners, like regardless of the other cost per clicks that designs might have gotten. And you just keep adding new creatives to this ad set. And now we'll talk about the budget in a second, but part of the reason that this works so well is because of the latest update with Meta called Andromeda, where basically we used to split up everything into tons of different ad sets, especially at the 1 to 2K a day level. You don't need to be doing that. You just need to be making better products. So this just one ad set. So 2 campaigns, 2 ad sets, catalog ad in one, and then just launching new statics here. And we keep the budget super low until we start seeing profitable results. And If we don't have any that are showing positive signs, then that just means we have to make more better designs. That's it. It's not something wrong with your structure. Like when I was starting out, if whenever I wasn't getting some winning ads, I would just assume that, oh, it just means that I need to, just make different ad sets and like piece together like different ads and like, well, what if I test out targeting on this one? And like, what if this one I just do four ads? Like maybe that's the trick. Or maybe I need to like let it run longer. Or honestly, like you can try all of those things, but I say all this to hopefully save you not just the ad spend, but more importantly, save you the time of just going on a wild goose chase that's ultimately going to bring you back to the same like fundamental principle that none of us can avoid, that great designs sell. Like we saw from all those student posts in the community, everybody who's reached any like a pretty decent amount of success and then shared about it openly, almost everybody has said the exact same thing, that I tried all these different things, came back to it, and it turns out that it's just more designs. Now, let's talk about budget increases. Right now, we're spending, if you haven't bumped the budget at all, we're spending basically nothing, $25 a day. And as soon as we're running at a break even ROAS, and to be perfectly honest, those $12.50 budgets, I start at the bare minimum at 25 or 50. But it's like the story of the tortoise and the hare. It's not one size fits all. It's like, are you trying to get results fast and you have a higher spending tolerance? Then you can start off with 25 or $50 a day budget on those ad sets. But I don't mention this earlier in the course very intentionally because as soon as people hear that, they start to over index on, oh, I just need to spend more. Then they end up blowing through a budget rather than just focusing on the designs. So by talking about it now, we can be hopefully more aware of the impact designs have like really has because you probably experienced it for yourself at least in some small way by this point. But when it comes to budget increases, our goal is that we use the system that we built. It's able to put in $1, get $2 out. Now we start to stress test this by slowly bumping it up. And just like any engine, the first time you get it on the road, you don't just put the pedal to the metal. There's still kinks that we're trying to work out, and it's not always just smooth sailing right out of the gate. So let's set realistic expectations that there's still work ahead of us, but we've made a ton of progress so far. So our mental model here is the engine is our catalog test. So it's always running. It discovers new fuel, which is winning designs. And we never want to stop this engine. We always keep this running $12.50 a day. And then the static ad scaling is like us testing out, pushing down on the accelerator to try and find more fuel. But in order to do that, we need to be filling the tank. There needs to be something for the engine to be running on this whole time. We scale winners with 20% increases every 2 to 3 days. And the fuel tank is set by our design creation cadence, which is 7 designs per day. But we have to keep in mind that there is a scale ceiling. This is going to be the 105th time we've heard about this, set by the number of designs that you have. So keep launching because if you ever stop refueling, eventually the engine sputters out and winners run out. Like you will have ads that start to do pretty well and then they just start to fatigue. Ad fatigue is a real thing. But when I do have a campaign that's performing well or an ad set, I'm bumping the budget by 20 to 30%. And the way that that works is you just come in here, you go to the ad set, and then you just bump it up like that. Or if you're like me and you don't like doing mental math, go here, budget, increase daily budget 20%. And now at $12.50 a day, 20% budget is only $2.50. So I would just bump it up to 20. But the reason that we're bumping by 20 to 30% is that it's slow and consistent enough that we are able to essentially bump without throwing off the algorithm. But again, at just $12.50 a day, if you're seeing 2.53 ROAS, I would start bumping and just keep launching as many ads as you can, which you need designs in order to do. But just start ramping things up because you have the flywheel there. It just needs more of a push to start rolling down the mountain. And just keep in mind, out of everything we just talked about, there's just 3 C's of scaling. So whenever you're like, I think things are going well, what should I do? The 3 C's are create, we make designs. 2, we cut, meaning we turn off the losers. And 3, we consolidate. We move the winners together. And we're simplifying the third C by everything happening in one ad set. which has been a change recently with Andromeda. And the typical success ratio on these static ads, to give you an idea, is about 1 to 20. So picture that. We just launched 5 in that one ad set. It would take 4 of those ad sets normally before we find a design that will consistently get purchases at a 2.5 plus ROAS, which is what we're really aiming for. And here's the criteria that I follow when bumping budgets. So 15 to 20% every 2 to 3 days. And what I'm looking at is the past 7-day ROAS. So if it's at a 2.5 plus, then I'm bumping it by 20%. If it's in like a 2.2 to 2.4 range, about 15%. And if it's at a 2 to 2.2, which is just above break even is about 1.9. And we'll talk about how we calculate that in the next lesson. But anything below that, I'm just leaving it. And if it's in the 1.6 to 1.8 range, then I'm cutting it. But if you're under $50 a day in spend, you should not be cutting anything because then you would have literally no traffic. I only cut if I have already bumped up to a decent amount, but this should rarely be happening since we've consolidated so much of the account structure down to just 2 campaigns, like the entire account structure. And we're going to leave a scaling guide linked down below this video that's going to include a decision tree that helps walk you through this. But keep in mind, again, that the goal of this is not to learn, okay, when this number over 2.6, then bump 20%. Because with that, that's just regurgitating. That's not actually fundamentally understanding. What we want to understand is at a 2.5, the ad is performing well. We are making 20% plus margin on that. So we want to get more spend out of it. We don't bump it by 100% or go crazy. Well, if you're at 1250, like bumping to 25 or 50, it's not a big deal. But if you're at like 100, we don't bump to 200 or 300. You just do slow, consistent bumps so it compounds. Then if the ad is just doing okay, or the ad set is just doing okay at a 2.2 to 2.4, then we do a moderate bump. But if it's just about where we want it, we're not going to start spending extra on it because we know that as we increase spend, the ROAS typically declines, which is another rule of thumb. There's an inverse relationship with ROAS and budget, meaning as we start to scale our budgets up, typically the ROAS will start to plateau or drop down until we get better and better ads. And it's normally at this point, right around here, that your mind may start playing tricks on you because it wants to make it more complicated than it seems. And we don't want to let that happen. Now, I'm not like trying to downplay this or oversimplify things, but in reality, what you have built is the backbone of the business. You have the acquisition channel, you have the optimized store, you have all the pieces. Now, your brain is going to start grasping at these tiny little incremental changes. Like, what if we tried a different account structure? What if we tweak the ad copy slightly? Like, all those things are fine and good, but there is one big, highest leverage activity that you can be doing and should be doing at all times. That is creating new designs. So, if you're ever not happy with the ad results you're seeing, just look at your accountability scorecard. How have you been doing with creating designs for the past 7 days? And if you don't know the number, step one is tracking the number. Have a spreadsheet, keep it simple and organized for yourself. And then two, make a contract with yourself that the only time you are able to get disgruntled or dismayed or whatever about the ad results is if you have made anything more than 7 designs per day over the past 7 days. And then the catch to it is once you have that kind of consistency, the results will start to follow. Assuming that you are not just iterating in an echo chamber and recreating the exact same designs again and again, that you're actually doing research, you're making sure that your research is getting translated into the designs. And on top of that, it's helpful to make sure that you fill out the stats spreadsheet that is linked down below. It's basically a day by day log of what's going on in your store, what changes you're making, and all of that is where you can also track the designs that you're creating. And if you ever feel like you've hit a plateau in your sales, maybe it's around $200 a day, maybe 500, maybe 1,000, maybe 2,000. If you're ever sitting stagnant at different levels, here it is for the 106th time, you just need more better designs. That is literally it. Commit to 7 designs per day for the next 30 days and then check your results because you're on the path to 10K. As of right now, we're driving traffic, things are converting, we're building our email list, but we want to make sure that we are actually keeping the money. That's why we're about to cover one of the most fundamental skills. We saw a little preview of it in the 0 to 7 figure store case study. Let's talk about profitability. and how do we turn these sales into dollars that are stacking up in the bank account. Profit is a choice. I'm going to say that again. Profitability in your business is a decision that we have to make and commit ourselves to as the business owners. Because if we are not committed to that sole focus, making that the only goal, the thing that is top of mind 24/7, then nobody else is able to do it for us. And that is something that took me way too long to figure out. And it really just comes down to a few simple decisions that we make in our day to day that can ultimately decide if we are stacking five, $10,000 per month in profit plus, or if we feel like we are perpetually stuck on a hamster wheel, just going around and around testing out new designs. And the beautiful part about it is that it really just comes down to running a P&L because just by doing that, I was able to improve my margins from roughly 3 to 5% and at low volume to upwards of 20% plus. Like we saw in the previous lesson, the 0 to 7 figure store, we had lots of months of 15, 20, 25K profit. And like our brand in the past 30 days has generated, like we looked at before, about 60 to $70,000 in net profit off of $430,000 in revenue. But we could do that same amount of revenue, and if we didn't know our numbers, if we weren't running our P&L, then we would be looking at a fraction of that. So that literally means just from the things we're about to cover, you can be with no additional effort in the business. This stuff takes about 15 minutes each week. It means 4 to 5 times more profit that I'm taking home. And to introduce this topic, I just wanted to briefly share a post that I wrote in the Accelerator a couple of months ago addressing this topic because I noticed that there were several people, like several members, that were doing a great job, like making great designs. They were driving up sales, they were hitting a ROAS, but then I kept noticing posts where they would say, like, I have a positive ROAS, but like cash flow is a struggle. And I'm not saying this to fault anybody by any stretch. Like, it takes a lot of courage and it's the right thing to do to share openly about your struggles and with a positive mindset. Like, everything in this community is extremely positive. It's no whining or anything of the sort. That's what I love about everybody in here. But the post that I wrote was addressing this, and that is the roadmap to basically getting to profitability. Because I ran brands for 3 to 4 years before I stopped believing that profit was out of my control. It just seemed like this kind of nebulous thing that floated around, like, oh, maybe someday the numbers will add up in my favor. Like, here's hoping maybe someday soon, like, just going to keep working away. And I was so naive. It was so easy telling myself stories like, it's just my niche, or ad costs are too high, or like my supplier fees are killing me. The reality was that I strayed away from the basics, more accurately, never had my numbers dialed in the first place. So the truth is, profitability is a math equation. It's all that it is. Dollars in, dollars out. We know how much we should be spending based on the benchmarks. And then anything that is outside the benchmarks, we then work to bring that back in. And because we are not here to build brands that get to 1,000 per month, 2,000 per month, like there is no reason that we cannot get scale up to 50 to $100,000 plus per month. Even if your goal is much lower than that, once you have a brand that's doing $10,000 per month in sales, or even like 5 to 10,000, you can scale that up. You can pour fuel on the fire. A lot of times we just don't know the numbers to be looking for. So in this protocol that we're going to be covering, I've distilled the exact lessons, realizations, and decision-making frameworks that help me regain control and finally start making consistent profits. Hopefully, what took me 3 to 4 years to figure out, it'll bring you the same in much less time. So all that being said, the key to the scaling protocol that we're going to cover is understanding how to run our numbers. What I mean by that is our profit and loss statement, P&L. This is a non-negotiable if you're going to continue with this business from this point forward. It is a non-negotiable that you run this as frequently as possible at bare minimum weekly basis, ideally daily, but do not let a week go by that you do not run the P&L. I'm going to show you exactly what that is. P&L, profit and loss statement, is basically it shows all of the money that came into the business and then all the money that left. So income minus expenses equals net profit. Fancy accounting term, EBITDA, earnings before interest, taxes, depreciation, amortization. Big mouthful of sentence. Very simple example. Say we had $1,000 in sales and $800 in expenses. That would leave us with $200 in profit. And our biggest expenses that we have are the cost of goods sold, our ad spend, transaction fees, overhead, then other miscellaneous stuff like refunds, returns, that sort of stuff. So here are the benchmarks that we're aiming for. We are aiming for cost of goods, meaning the total amount that we are paying to Printify, to be in the 40 to 42% range, meaning out of $100 in sales, 40 bucks of that went to Printify. Then ad spend. We are aiming for 25 to 33% of that of our revenue going to ad spend, which means like if you take 33%, that means we want to be at a 3x overall. So if you take your total sales divided by total ad spend, that would give you your percentage. Then transaction fees, this is set pretty much by default by Shopify, but that's the next biggest expense. Then overhead, this is all of the softwares, apps like Shopify, Klaviyo, any apps that you have on the store, that sort of thing. And we want this to be around 3%. I had at one point, we stopped tracking this and it was up to about 10% of revenue. It got insane. We were paying like $35,000 per month in just software fees, which we did not need. It should have been like 5 grand. And that was with us being on like the highest Klaviyo plan, highest Shopify plan. We just were not running our numbers. So, profit and loss statement, what is it? It is a summary of your business's revenues, costs, profits over a set period of time. So, I recommend running it daily. Why does this matter? Because it shows our business's financial health and helps guide decisions that ultimately increase profitability. Run it daily. Weekly is the absolute bare minimum. Run it daily if you want to be as successful as possible because what gets measured gets grown. So run it daily so we're able to track revenue, control costs, and optimize profits. And then we're able to use the insights to plan for growth, like seeing if we're actually, making money or not. It's a necessity. So this is the P&L for our 0 to 7 figure brand in the month of November. So this is the time period that we're looking at. So this was last month, generated $283,000 in sales at a 2.5 ROAS. Let's break down and see how we get to this profit number. And if you're wondering why it says 304,000 for total sales, but on Triple Whale, which just pulls in the Shopify data, it says 283. That's because Triple Whale is excluding discounts and refunds, and it's sometimes off by like a couple grand, but or like which is really less than 1%. But so starting off at the top, we have the total amount of Shopify revenue that was generated. So this is the gross sales and the shipping revenue that was paid to us by the customer. And we're going to fill in a P&L together in just a second. So we'll see how to grab each one of these numbers. Then we have our total cost of goods. And by the way, the template for this P&L is linked in the description down below in the lesson in the free school community. And then next we have platform costs, which is really just discounts that we gave out and then any refunds, which note our refund rate is about 1%, which is really, really good. And yours should be almost spot on since we're using same supplier, same types of products, same quality, same shipping speed, all of that. So that gives us a gross profit of $157,000. So that's gross profit is just the total sales minus the cost to fulfill. So it's cost of goods essentially, basically every expense except for overhead and marketing and transaction fees. So our transaction fees were $12,000. And the reason that PayPal says zero here is that PayPal is now integrated with Shopify payments. So they all run through the same. But if you didn't set up PayPal, by the way, make sure to set that up if it's available in your country. About 40 to 50% of our sales come through that because it's such a trusted name. Next, we spent $107,000 on Facebook ads, tiny little bit on Google, which I don't recommend getting into that until you're doing 30 to 50K per month. But until you get to that point, like you don't need to be even entertaining the idea. You can keep it really simple. Then we have contractors. We have team members who help handle our customer service, which you don't have to worry about this right now. That's for much later. Then we also have a accountant slash bookkeeper. Basically, once you get to about $100,000 per month, that's the time that I would definitely have a bookkeeper or an accountant. So bring in 15, 20K profit. But until that point, just this is not financial advice, but just best practices. Keep all business expenses on one business card and all personal expenses completely separate, just for super easy tracking and to make sure that it's as compliant as possible. But we do have an accountant now. So that gives us a total operating income of 32,000. Now, because we do so much volume with Printify, we get a rebate off of the sales that we generate. And so they have tiers inside. So at the time of recording this, our brand has done enough that we are making about 5% back on cost of goods, which gets added to the P&L here. And then we have our credit card that we use. So we have a Capital One 2% cash back that we put all transactions on, and that brought in an additional $4,600 in profit. So that's an additional income of 11,582. Grand total income 44,000 at a 16% margin. Then down here we have our core stats. So our off Facebook ROAS and our cost of goods sold and overhead is a percentage of revenue. So that's interesting actually. The triple whale is not as far off as I'd thought. Yeah, 50,000. So it's off by about 10, 12% because it's 44 was the 44 was the actual. And yeah, that's good to know. I thought that it was off by like 20 to 30%. Anyways, so this is basically what the P&L looks like. And the reason this is so valuable is this breaks it down into basic math so we can see exactly where every dollar is going. So now that we understand what every number on the P&L is meant for, now we're going to pull the numbers ourselves. So we just start top to bottom and we go with Shopify gross sales. So how do we get these numbers right here? We go into our dashboard and we go to analytics. We switch to the date range and then we click that. We say total sales over time. So we had $280,000. Let me zoom in. $280,000 in gross sales. So that goes right there. And then shipping sales. So this is the $4.95 that people paid at checkout for shipping. That's this right here. So we just copy that, paste it in, and that totals our gross sales. While we're still in the dashboard, I'm going to do discounts. So we get discounts from right there, and then refunds we get from right here. So the number you're seeing on your dashboard, this 279, is actually after it's factored for gross sales, discounts being taken out, returns taken out, and then net sales is just gross sales minus discounts minus returns. Then they add the shipping charges. And then if you're collecting taxes, which you won't be in the beginning, then that gets added on as well, which sales tax, state sales tax is a whole nother can of worms. Long story short, this is not financial advice. It's just what we do in our brand from our experience. We wait until Shopify gives us a notice that we need to start collecting sales tax in a specific state. And until then, we don't worry about it and you can ask ChatGPT to read up and get more information about it. But now for the Printify charge, how do we find that? So we go down to Printify. And then we come down to wallet and then invoices. And then come to the calendar here and then go to November. And then here are all the invoices that we receive for the month. So starting out, you're just going to be targeting the United States. You only start targeting international once you get to 10K plus in sales. And at that point, I highly, highly encourage you to join the accelerator if you haven't already. Honestly, as soon as you turn on ads is the time that getting an expert coach looking over your shoulder and getting comments and feedback from hundreds and hundreds of other people who have spent millions of dollars in ad spend is worth its weight in gold. Like if they can help you make even one tweak, it can save you 10 times more than the monthly cost. So anyways, that aside, you're not going to be looking at any of these, like all these different invoices for the time being. You're just going to see the United States one. But for us, we just go through and add up all of these. And then that becomes the Printify charge there. And if we click into one of the invoices, what we see is across the top here, the invoice. So I just picked one that's smaller, so it's easier numbers to look at. But this is for Canada, so you just be looking at the United States one. They all look the same. But we see it's broken down into a couple of different numbers. So first up, we have the production cost. So this is the cost of the actual t-shirts itself. Then we have the shipping cost. This is the shipping cost that we paid to Printify. And then we have the tax amount, which is the amount that we are paying in taxes to Printify on top of, it's basically taxing for shipping and the production cost, and then the total amount that we paid. So that's how the invoices work. And they generate these on a monthly basis, normally on the 3rd or the 4th of the month. So to run this on a daily basis, what we do is the way we set up Printify way back many moons ago now, it feels like, that it bills on a daily basis, or there's a way in Printify that you can export your orders so that you can see the daily view. So that's how we get Printify. And then these are formulas, so we don't worry about them. And then for transaction fees, the way we get this, you go to finance, payouts. So if you're running the P&L for just a day, you would just click on one of the payouts here and you would be able to see the fees that we paid for that date range was $195, which comes out about 5.7%. So depending on if you're like ours is slightly higher because we're selling internationally, but yours will generally be around like the 4%, 4 to 5% range. So you can also run a report in analytics that will pull it for the entire month. But what I personally recommend doing right now is run this on a daily basis. So you'll just be looking at the specific payouts. Or if you want to go the fast way, just round out to about 5%. And that normally covers, it'll honestly normally be lower than that if you're targeting just the United States. Then our Facebook ad spend, the way we pull that is we just go to the ad account and we just go first through the 30th, 107,000. Plop that right there. Google, we don't have to worry about. Then overhead expenses, you just go basically add a tab to the spreadsheet and just list out every subscription. Just go through your credit card, list out everything that you're paying for, and then turn that into, if it's a monthly fee and you're running this daily, you would put the daily fee here. So if it's say a $90 a month charge, I would put $3 per day when I'm running the daily P&L. Say I have $3,000 in total monthly expenses. If I'm running the monthly P&L, I would put $3,000 here. If I'm running it daily, then I would put 100 here because we run the P&L on a accrual basis of accounting. And accrual means that we basically spread out the charges effectively. So we don't have days where, you know, a Shopify bill might hit and then it looks like we were just insanely unprofitable. Like, no, the other days of the month we're benefiting from that. That's roughly how accrual works. Then contractors, we don't have to worry about. Accounting, we don't have to worry about. Any credit card rewards, you drop them in there. And that's pretty much that's how to run the P&L. So that's how we do it. You run it on a daily basis. So just remember that the reason we're running the P&L is that sales are vanity, profit is sanity, and cash is reality. And we got into this to make money. So let's make sure that we keep it. So now that we know how to run the numbers, find the cost of goods, and basically track everything, we now know every metric in the business. We may not know it to the expert level that we would like, but getting comfortable with that uncertainty will do us well because scaling in business means that we are welcoming new, bigger challenges for ourselves. And that's how the business grows. Like I used to think that there was this big plateau part where things would just get easy and I would, golden goalposts, all of that. And it doesn't really happen. It just like lock into enjoying the process and starting to learn what each thing means. And this is a perfect time to bring up our next topic, which is the scaling roadmap, where we bring everything all together into a solidified system. The scaling roadmap is my absolute favorite area of anything that we get the opportunity to teach. And it was something that for me, once it really started to come together, if anybody has seen, I'm sure some people have seen it, maybe a handful have seen the movie The Matrix. There's a scene in the movie where, the main character starts to like really see and like understand what's going on. And he starts to see like opportunities and things that he can control that he never really realized that he had control over. That is what the scaling roadmap, this exercise that we're going to go through, did for me in my business and what has helped many people in the community just from their own feedback really become like the true owner of their brand and have complete control over everything. So if you're currently feeling like you've got a lot of things going, but you still want to nail down the fundamentals, want to get into a good routine, still feels like we're kind of firefighting, this is the lesson that we're going to absolutely change that once and for all. So, what is the scaling roadmap, aka scaling protocol? It's basically a decision tree of what we should be focusing on and what we shouldn't. So, we're going to start off with an exercise before we actually can use the full tree. And we're going to go through the decision frameworks, basically how everything plays out. First, there's a really important exercise that I want to share with you. and that is the scorecard exercise. So looks somewhat similar to the P&L, and some of the same numbers are on here, but it also includes the key KPIs. So cost per link click, conversion rate, average order value, the three main levers that we have on the business. Those are also factored in here. And the whole premise of the scorecard exercise is that we fill this in on like in the mastermind community of people who sellers who are at 50K plus in sales. We do this on a weekly basis and we review it together every single week, looking at everybody's metrics. It's a complete open book and we give each other feedback. We identify the opportunities. And the way that it works is you fill in every week. So your total sales and then your net profit margin. So you get this from your P&L. And what we're looking for here is like our sales going up week over week. And if they're going up, that's great. But how much of that is actually profitable? And we want to be in about 15 to 20% range overall. Then ad spend and ROAS. And the reason that we have ad spend here is so that we can, you could just say put the ROAS, but when we have the ad spend, we're able to calculate the MER, which is the off Facebook ROAS or total sales divided by total ad spend. And then you put in the ROAS from your ad account, your cost per link click, your conversion rate from Shopify, your average order value, and then your email stats. So, how much did you generate from your campaigns? How much did you generate from your email flows? What's your pop up sign up rate? And then the main expenses. So, cost of goods sold as a percentage, overhead as a percentage of revenue, and then our inputs. Number of new designs launched, number of new ad creatives tested, so new static ads launched, and number of email campaigns sent. So, what this tells us, and we're going to go through lots of examples here. This is the most important skill I could ever possibly hope to impart upon you. I know spreadsheets aren't the most fun for everybody, but this is where the magic really happens. Don't even think of this as a spreadsheet. This is us in lieu of being in the store, being able to see eyes on what's happening in the business. This is our way of doing that. So you wouldn't want to run your business blind. This is how we are able to finally see. So what we are looking for between total sales and net profit margin is that we are at 15 to 20%. If we are not at 15 to 20%, then the first thing we look at, first thing, can't really snap. There we go. First thing we look at is we don't ask like how are the ads doing or anything. We ask the question of why are we not profitable? If it's not 15%, remembering back to what are the two main, like think sequentially, like we did with the conversion rate, how we went add to cart, reach checkout, sessions converted. Do the same thing with profitability. What are the largest expenses? And we already covered these. The largest expenses that impact our net profit margin are our cost of goods sold and our ad spend. So our ROAS. So first thing we look at is what is our overall off Facebook ROAS? And if we're at a 2 ROAS, like meaning say we had $10,000 in sales, we spent $5,000 in ads, that's a 2. That means that our profit margin should be at about break even. So that's not where we want to be, obviously. Then when our ROAS is at a 2.5, we should be at roughly a 10% margin. When we're at a 3, should be at roughly like 18%. When we're at a 4, it should be at roughly 25 to 30%. And the way we know that is because at a 2, that means that ad spend is taking up 50% of revenue. At a 4, it's taking up 25%. At a 3, it's taking up 33%. And at a 2.5, it's taking up, what is that, 40? Yeah, 40%. So it makes sense because our cost of goods, all other expenses stay pretty much static. There is some variance in like cost of goods and overhead, but it pretty much comes out to about 50% for everything else. So why is this so important to know? Because it tells us if we are not profitable, and remember, profit is a choice, 100% a decision, and I choose to say yes. So the first thing that we're looking for is does our profit margin relative to the overall ROAS, the MER, marketing efficiency ratio, does it give us any cause for concern? Meaning, when I see a 2.5 overall, I want to see that we are at a 10% margin. 8 to 12% is acceptable, like 20% variance either way for any of these numbers. But if I see that we're at a 2.5 ROAS and our profit margin is 0%, and assuming that we ran the P&L properly, and we have the right ROAS, like if I'm looking at a 2.5 here, I know that this should be 10%. And again, it could be 8%, it could be upwards of 12 a little bit, but it should be about 10%. Now, when I say cause for concern, what I meant is if I see that we're at a 2.5 and we're at 0%, alarm bells should be going off because that means we have a leaky bucket somewhere else that we should not be losing money. The only two other places that this could be happening, and it's not even close, it's cost of goods sold. So as a percentage, we want to be at 40 to 42% max. If you start getting up into 44, 45%, then that's tough. Like we want to be at 40 to 42%. That is the range that we have found you are able to be consistently profitable. But as you creep up higher than that, then you start to really eat into margin. So the way that you get your cost of goods to be in that range is you do the math on how much you're charging your customers and how much you're paying to Printify. It's as simple as that. And then you factor in discounts. So to give a benchmark, we charge $29.99 for Gildan 64,000 and we charge $4.87 for shipping and we have $75 plus for the free shipping threshold. Now, in our email pop-up, we give anywhere from a 10 to 15% discount. And so that comes out of the cost of goods as well. So things that could drive up cost of goods is over discounting, underpricing, low average order value. Because when you have a low average order value, our shipping cost that we pay to Printify decreases as customers add more products. Like it technically goes up, but it decreases relative to each product. So like for the first product, we pay about $5 in shipping. For the second product, we pay about $2.50. So the more products, and we pay the same acquisition cost. So the more products we're able to get people to buy, then the lower the cost of goods will be. So as long as you have average order value at $45 plus, you are giving out 10 to 15% discounts and you are pricing at least $29.99 base price for the Gildan 64,000. If you're Comfort Colors or Bella Canvas, you need to be pricing higher. But as long as you follow this, then your cost of goods should be in the 40 to 42% range. And as you ramp up, you're able to get discounts from Printify, so it comes down over time. So that's the first number we look at. And the first thing we do with the scorecard is see, does the profit margin relative to the overall ROAS make sense? So if it doesn't, we talked about cost of goods. The next thing we look at is overhead as a percentage of revenue. So this number should be 2 to 3%. If it's any higher than that, then it means that we should be cutting expenses. Like there's not really that much that we need to pay for. Now, the caveat to this is when you're doing, say, $1,000 in sales, then a Shopify is going to be 5%. So that's like your overhead's going to be 10%. So this is really after you hit like the 10K in sales mark. These are the numbers that we should be trying to hit for. So at 10K in sales at 3%, that means you have $300 for overhead expenses. Shopify, you should be on the $39 or $49 month plan, or even if you're on the 100, you still have $200 left over. Klaviyo should be like 50 to $100. Then you have $100 left over for like random tools and apps and stuff. And there's your 3%. If it's 5, 6, 7%, practice self-discipline with the finances, set a reminder on your calendar, go through and clear out those excess expenses. Because I promise you there's some piling up that you probably don't even know about. So then say we're at a 2.2 ROAS and that gives us a 4% margin. So it doesn't give us cause for concern because we know that this lines up. So we are as profitable as essentially the brand deserves to be right now. It tells us that if we're at a 2.2, I would expect us to be about 4% profit margin. So that means that how do we get more profitable? We just make this number go up because everything's stacking up. It's reflecting. There's no leaky bucket. We just need to make this go up. So how do we make that go up? First place we look is what has been our Facebook performance recently. So we look at this, and especially early on, you're not going to have much email revenue coming in. So your Facebook ROAS is going to be carrying like the brunt of it. So if our Facebook ROAS is say like a 1.9, well, then we focus on, okay, number one priority is how do we get this ROAS to go up? Well, we know the ROAS is just made up of three numbers. It's the cost per click, conversion rate, and average order value. So we focus on these in order of priority. Same way that we set it up as we went through and built our brand. So we focus on the cost per click first. So we see what is the cost per click. And if it is anything less than a dollar, we're in good shape for starters. But we want to aim for being at 50 to 75 cents overall. Because as you're loading in new winners, this cost per click should be dropping further and further. And now, if you're at a 1.9 and we see that this is over a dollar, then we just found our number one opportunity. Number one opportunity is lower the cost per click. How do we lower the cost per click? Test new designs. That's it. You just keep making designs and you just keep doing that until this is where it needs to be. And then let's say cost per click is in a good spot. We now have it at 50 to 75 cents, but our ROAS is still a 1.9. Well, how could that be? Well, it's not cost per click. So we move on to the next one, conversion rate. So conversion rate. If this is below a 2.5, then we know that we have to optimize the conversion rate. How do we do that? We start with the add to cart rate, tweak the collection page, the product page, then reach checkout, then sessions converted, and we keep working on this until conversion rate is at a 2.5 plus. Well, what if we have good cost per click, good conversion rate, but average order value is low? Well, we could still have a low ROAS. So say this is at $35. First thing that I would check if your average order value is that low is check your shipping settings. Make sure that you don't have some egregious rate that nobody wants to buy more than one product because they get charged an arm and a leg. That's the number one culprit. Number two, make sure you have free shipping threshold. Don't get cute and have anything fun in your announcement bar. Just have $75 plus. And then make sure that you have lots of related products so that there is something that people would want to buy in addition to the product that they clicked on the ad to see. So once our cost per click is in this range and conversion rate is 2.5 plus and average order value is 45 plus, then mathematically our ROAS should be at least at a 2.0. At least it should be higher than that. We want this to be around like a 2.3 to a 2.5 overall because the range that we're shooting to stay in is around a 3 overall for this number. And if you're wondering like where are we getting all these numbers, it just comes from benchmarks. It comes from us testing and knowing what we're able to consistently do at high scale. It's about a 3 overall. And also there's a point of diminishing returns with this. So we don't want this to be a 10 because it starts to drop off in terms of profitability. We're better off pushing higher volume. And then we look at our email performance. So what we're aiming for in terms of our email revenue, as we talked about in the email training, is 25 to 30% of revenue is what we're able to get to. Now, it takes some time to build up to that, but we're looking for roughly 50% of that to come from our flows and 50% to come from our campaigns. And the pop-up rate that we're aiming for is anywhere from like 5 to 10%. We currently have about 12 or 13%, but you start off with Klaviyo, and then once you're scaling like past 10K, I would recommend looking into a software called Aaliyah. That's what we're currently using. And then we have cost of goods and overhead as a percentage of revenue. Now, the most important section of this whole scorecard exercise is down here, is the inputs. And the beauty of tracking this is that when we're looking at just the P&L, it paints the picture of what's already happened. It doesn't paint the picture of what we did to contribute to things getting there, for better or for worse. And this is the view that so many sellers need to have front and center in order to be completely realistic with themselves about what they have or have not been doing. Because I can say from personal experience, it is all too easy as I'm getting lost in all the different numbers and I got emails and all that stuff to lose sight of and just not launch designs. Launching new designs is the highest leverage activity. We surveyed everybody in the mastermind and found there was a direct correlation between sales and not only number of designs published, but consistency of designs published. Meaning the top 10% of sellers, they never missed a week. They were always uploading and they were always launching new designs. So recommend shooting for at least 25 to 50 new designs per week. And honestly, you could go so much further. Like you could launch 100 designs per week and that would not be too many. And then your number of email campaigns sent, we recommend sending at least 2 per week. And we're going to talk about the flow that we can use for setting these in just a second. But this is an exercise that if this didn't make sense to you, which I know it's a lot of numbers, a lot of color coded charts and such, highly recommend rewatching this portion of the training because this exercise, once you understand what we just went through, everything starts to make more sense. Like the answer of like, why am I not profitable? Like, where I feel like I've invested all this time, all the normal stuff, it starts to paint a pretty clear picture for you. Because once you see that, oh, the reason my profit margin is low is because my overall ROAS is a 2.1. So if I want profitability to go up, it's not guessing, it's not magic, it's not rubbing a crystal ball. It's I need to make that go up. If I want this to go up, it's three numbers. I either need to get cost per click down, conversion rate up, or average order value up. It's one of those three things. Now, doing one of those three things is what we just covered in the whole training. So it's easier said than done. But the fact remains you need to sit there and focus on the number one opportunity until it is solved. And that's why we track this. And then you write in what is the number one opportunity. So if I saw that net profit margin was at 4%, we're at 2.1. Number one opportunity is increasing this, but this is just a formula. That's not an action that I can take. So we want to keep unraveling till we get to the action. And it's increasing one of the core metrics. And then you translate that into the action. So if it's cost per link click that needs to go down, then your number one opportunity is launch new designs. Plot twist, it's almost always launch new designs. That's the answer. Unless if it's like conversion rate optimization, then sometimes that's just making changes on the site. So here are each of the metrics that we just went through: cost per click, add to cart rate, reach checkout, sessions converted, average order value, and ROAS. Now let's go through the scaling protocol. And it works like this. And the reason that I made the scaling protocol in the first place is this right here. Understanding that profitability is not something that we want to leave up to chance. It is simply math, and we are the ones in control of the variables. The margins that we're talking about here are industry average for any direct to consumer physical product brands. These are not unique to print on demand. And brand building is a compounding business model, branded POD. So the vast majority of the gains come from consistent, controlled growth over an extended period, not quick, uncontrolled spikes. And always remember that there are real people on the other side of these numbers. And achieving high profitability at scale, like anything, comes down to the basics. So the question is how consistently we're able to execute on those basics, especially when it starts to feel boring. So the three inputs for 100K plus months at 15 to 20% net profit, this is what everything's been building up to. Here is the secret sauce. It's products, marketing, and operations. In general, it's a relatively simple business model. Like there's not too many moving pieces. Not saying it's easy, but this is it. We make new, better products. We market with ads and emails, and we have our back end, which is basically Printify. And the reason that like hearing this is one thing, but then our brains naturally start fighting against it. To me, it's really interesting to break down like what drives our brain. So our brain is driven. It's almost like the exact opposite of what you would hope for. It's driven by novelty, patterns, rewards, and things that are emotionally relevant to be interesting. So basically, it's looking for novelty and surprise, patterns and predictability, rewards and dopamine, and emotional significance, and information seeking and curiosity. Basically, our brain loves shiny objects, which is anything that is not our number one opportunity is a shiny object. It wants consistency with low effort. So if you want the consistent sales in your ad account, it requires effort. It is not just hoping and thinking that it's going to happen for you. And I see too many people get to a stage where they feel like they've, I don't know, hit a wall or something. And then you look at their ad account and it's like, well, you just haven't been launching anything. So if you just want to stop, then go ahead. But it's not that there's anything wrong with your brand. That's like nine times out of 10. It's nothing wrong with their brand or their niche or anything of the sort. It's just like them. And I mean this in the best way possible. Like we have complete control because our brain also wants immediate gratification and it seeks emotional experiences. And the information seeking curiosity is good unless if it leads us astray and goes to shiny object syndrome. So our brain basically loves chasing random shiny things. It wants consistent, it wants the reward without the effort, and it wants the reward right now. And at the same time, it likes to just lob a hand grenade in there and seek out emotional experiences, like specifically like excitement, novelty, shiny objects. So that's what we're up against. So what we do with this is simply keep it in mind, no pun intended. But we keep it in mind that anytime we're not feeling like making designs or we're trying to explain away to ourselves like why the new app or something is what we should be adding, then basically this is the explanation for why that happens. And so just by having awareness that this is going on has personally helped me. So we are starting here at the beginning of the scaling protocol. So if you are in the 0 to 10K range, then I recommend staying at the test cohort level, basically meaning, and within the accelerator, there's three different levels. Or three different cohorts. Well, four technically with the mastermind. It's launch, test, scale, and the mastermind. So launch is with everybody who is building their store, getting ready to launch their first ads, but hasn't spent the first dollar on ads yet. That's everybody in launch. Then in test is everybody who is running ads and they're working to get to their first 10K in sales. Scale is once you reach that point, and then we talk about like those calls focus more on like marketing, like ad strategies, that kind of thing. And then mastermind is once you reach 50K plus in sales. And that's when we do the scorecard exercise, a whole bunch of other stuff. But anyways, just to explain like the cohort reference. So assuming that we are at 10K in sales, and if you are not, then just go back to rinsing and repeating. Launch designs, dial in cost per click, conversion rate, average order value, rinse and repeat, increase the budgets. And if you're seeing positive ROASs, really increase them. Like it should not be at $15, $20 per day. It should be 50 to 100 per day. Because just forget about the 20% bumps when you're at like $12 a day. Like now this is not financial advice, but when it's me, if I see something that's at like a 2.5 plus ROAS and I know that I have lots of designs coming in the pipeline, then I start increasing the budget. So if you feel like you're a far cry from 10K, look at your results and see if there's an opportunity to bump. Because a lot of people are apprehensive to do that early on, but not saying jump the gun. Only do that if you know that you have a consistent pipeline of new designs coming in that are ready to get tested. So creating at least 20 designs per week, and we've now upped this since the past couple months. This should be at least 25 with the new design, and we're constantly updating this number based off of what we see is reasonable and possible in the market given like the tools. Like you were making designs with Eric, you saw how fast you're able to go through it. Now obviously Eric has practice, but you should be 100% nailing this KPI. Next prerequisite before getting into any of this is we're running the P&L daily. So you do not pass go, do not collect $200 unless you are at 10K in sales, creating 25 designs a week, running your P&L daily, your email flows are set up, and you're sending at least 1 to 2 email campaigns per week. So, assuming that we have all of this out of the way, that's basically the table stakes. Now, here are the budget increase rules, and we evaluate these every 2 to 3 days, except for on Mondays and Tuesdays. So we look at the past 7-day total ROAS, and if in the past 7 days it's less than a 1.6, so we look at past 7 days and then today as well. So let's give an example of this. Say we're looking at this campaign and deciding if we should bump it or cut it. And you would do this either at the campaign level or the budget level, wherever your budget is set at. So, like here, this is where the budget is set. So, all the campaigns that we set up together are using ad set budget. So, in deciding if we want to bump or cut this budget, what we're going to do is select the campaign. And I'm first looking at the past 7 days. So, past 7 days, it's been running at a 2.4 ROAS. Then I look at today. Well, right now it's like yesterday. It like just changed. So yesterday it was at a 2.48. So this campaign is running really well. It's at a 2.5. So let's follow our rules. Let's see. At a 2.5 plus, increase budget by 20%. So we would come in here, increase by 20%. And the way I like to do this is I save them. If I have multiple ad sets that I'm going through, I just save it to draft and then I publish all of them at the same time. I like it because then it highlights it in green. So it's easy for me to tell which ones I've already done or not. So that's what the bump would look like. And then say on the flip side, if this ad set or campaign was running at under a 1.6, then I would reduce the budget by 20%. And don't get caught up on just hearing the number and then like, okay, 1.6 equals down 20%. Got it. You need to understand the why behind it. Because at a 1.6, that's bad. That is very bad. That is unprofitable. It's not very bad. It's like just not like in testing, that's completely fine. I'd be happy with that. But for overall, like when we're starting to scale things up, we want to be basically well beyond this because at 1.9 is about break even, 1.9 to 2. depending on your cost of goods. So 1.6 is bad, so we lower it by 20%. 1.6 to 1.8, it's not great, but it's definitely not good. So we've reduced it by 15%. And then at a 1.8 to a 2.2, we hold the budget at zero. And then at 2.2 to 2.4, it's doing pretty well. It's not like blowing the doors off, but that's why we bumped it by 15%. And then at 2.5 plus, we're in really great spot. So we increased by 20%. And that's all that it like when we talk about bumping and cutting, that's all that we're doing within like if you're ever wondering like if you should be bumping or cutting, it's just this right here. So if you have an ad set that's running at a 2.5 past 7 days and doing well today, and so to elaborate on the today thing, like if I saw this was at past seven, 2.4, and then today it's at a 2.1, I could bump it, but I'm more likely to just like let it running. Like just give it another day and then I'll see because I don't want to try to bump something that might be having like a downward shift. So this is how we bump at the campaign and the ad set level. Now we want to diagnose how is the account performing overall, which this ties into the scorecard we just did. This is what's our overall ROAS in the account. So if we are starting at the low end at less than a 1.8, then we want to stop bumping budgets and we want to launch more ad creatives to bring that down. We don't want to keep ramping up spend on something that's not profitable. So if you are at less than a 1.8 overall, one, you're probably going to be cutting some things or decreasing budgets, but you definitely do not want to be ramping things up. So if you're at a 1.8 to a 2 overall, then you want to scale cautiously while testing new creatives. And if you're at a 2.5 plus, then basically you're just in a great spot. You're right where you want to be in order to keep moving with the scale protocol. And then we get to the next revenue driver, email as a percentage of revenue. So the decision making framework here is if our email is bringing in less than 20%, the way you find that is you either go to Klaviyo and it'll have the percentage in the dashboard, or another way is you can use Triple Whale, which that's the free tool that I've been referencing, where you just connect Shopify, Klaviyo, Facebook, and it basically just pulls in your metrics for you. And we generated $89,000 in total email revenue last month. So just take 89 divided by 283. So we're at 31%. So if we are at less than 20%, then we want to prioritize flows like welcome, abandoned cart, post purchase, and send 2 to 3 email campaigns per week. And what we're going to wrap up with in this lesson is basically the cadence that we can be doing that brings all this together. So you can be checking all of these boxes basically on autopilot without even having to think about it. You just commit to one process. And then once your email is up to 30%, so the way you get to 30% is you have a 5 to 10% email pop-up rate. You have flows that are generating 15% of revenue, like your welcome flow, your abandoned cart, browse abandonment, all the ones you set up with Eric. And then you're sending 2 to 3 email campaigns per week. That brings in another 15%. And when you do that over time, you should gradually build your way up to 30%. And the reason that this is so important to the overall picture is that email all of that revenue offers such great padding to our ad performance because we're able to bring these sales in. Like the flows are just running automatically. It's like awesome. So it's just bringing in sales on autopilot. And then the email campaigns, we send it and we could do, even if you do a couple $100s, it's an extra couple $100 in profit that then like when the ROAS naturally, and the ROASs do this, they will go up and they go down, and they go up and down until we reach a critical mass of we have so many great ads in the ad account that things start to stabilize and just take off. But it can feel like you're riding a wave up and down until you get to that point. What's able to help us with this and not feel the downs nearly as much while we're building our way up is by having emails sending so that even on the down days, we're really not that down because emails are bringing in sales for us. So it's like the goal of this whole protocol is that we're able to increase budgets as much as possible. And this is essentially dialing in all of the areas of the business to make sure we're set up for that. Next, we look at the store conversion rate, which we just talked about in the scorecard exercise. So we want to be in the 2.5 to 3% range or 3% plus, even better. And here's what we talked about at the beginning of the scorecard exercise. See how it's all coming together? Bueller. So the profit margins we were talking about here, based on the overall ROAS. So at a 2, we're at 0%, at a 3, 15 to 20, so on. And then you come down here, and this whole thing has been like a sluice gate. Like you don't move on to the next. The water can't flow until the first gate has been released. You need to have all of these things dialed in before you can get to the point of, yeah, like let's really start ramping things up. Because like what would happen if you started ramping up earlier before, like while email is only 5% of revenue, say? Well, every time you could do that, you could start ramping up spend, maybe get to $1,000 a day, but then every time your ROAS takes, 20% dip or 30% dip, you go from being at a 2.5 overall to a 1.9. Opposed to you have email in there, and even when your ads take a 20 to 30% dip, you're still profitable because emails are bringing in revenue. So it helps to basically set us up for to be able to ride out those ebbs and flows. And the way you do this is you just lock into evaluating you just run the budget bump rules every 2 to 3 days, except for Mondays and Tuesdays, because that's when everybody's back to work, not really scrolling. And to put this in perspective for anybody watching who's in the 0 to 10K range, when you're at this point, like less than 5K in sales, I would expect this to be roughly break even. So up until that point, we're testing a ton, we're dialing in all the metrics, we're getting the machine humming along. So about break even is very normal there. Then once you're at 5K in sales, we're aiming to be at 5 to 10% profit margin. So nothing huge yet, like 10% on 5K, it's 500 bucks. Nothing to turn our noses up at, but we're here to scale much higher than that. So once we're at the scale cohort level, meaning 10K plus, we're aiming to be at 10 to 15% overall profit. And then once we're at 50K plus in the mastermind, then we're aiming to be at 15 to 25% profit margin. Because once you start to hit like economies of scale and you're able to reinvest in like hiring designers and offloading customer service, growing your team, you're really able to free up your time to focus on driving up the profitability. So the way to apply this in your business is, and when this can be helpful, is periods when you have flat sales, periods when you have increasing sales, and even periods when you have decreasing sales. So the only three circumstances you could possibly be having in your ad account or in your store in general, because what we do not want to do is this. Take a look at our Shopify metrics. We take all this data that we could make decisions off of. We don't want to just look at it and then chuck it in the fire and then get upset when, the brand isn't scaling the way we want to. Or worse yet, go and split our focus into shiny objects, that kind of thing. Just use the scale protocol and keep rewatching this until it really starts to sink in for you. Because this is the piece that for me was missing for a long time. It's understanding what I can control. And if I'm trying to get to profitability or if I want to scale faster, this is where I should be looking. And now here's the one workflow. This is beautiful. It brings together everything. So if you do just this one thing every week, your business will grow. So this workflow is broken down into 9 distinct steps. And the beautiful part about it is that this brings together all of the core elements that we've been talking about throughout this entire course. It is creating the designs, it is sending the emails, it's publishing them to the site, it's testing in the ads, it's following up your customers. Like it brings it all together and leverages each asset in such a beautiful way that it gets a snowball rolling down the hill in our favor. So, step number 1 is make new designs. So, you need to have new designs coming into the pipeline in order for this whole flow to work. And sharing a number of products from a site, just as a frame of reference, on our store, we have 1,200, 1,300 designs now. On Sloth, there's several hundred. Yeah, 355. Now, keep in mind that was with Eric making designs, and he has a lot more experience. So, to get to the kind of sales that he has as a beginner, I would expect it to be in the 6 to 700 design range. And if you're looking for inspiration or ways to increase the number of designs that you're outputting, we have lots of workshops inside of the accelerator where we break down the latest AI tools and workflows, and we have guest speakers come in who are design experts to share their take so that you'll basically never have the feeling of hitting a creative wall. You should have a endless stream of designs flowing into your business. So Once we have that, we have 25 to 50 new designs per week. Step number two is the new arrivals email. So, this is a campaign that we're going to send to our email list. And the beauty of this is these are some of the top performing emails in terms of sales without having any discount code or actual sale attached to it. So, we keep the full margin. And the way that it works is this: you're going to use for the subject line the number of new designs that just launched. And we do this every week. So, number of new designs that just launched, and then a emoji, mjoy, a emoji that's related to your niche. So for sloth, you can use the sloth emoji. For Slice Club, you can use a golf emoji, and then you address your brand avatar. So for sloths, it'd be hey sloths, pretty simple. For Slice Club, it'd be hey slicers. For Yoga Stay, it was hey yogis, and then say this is your name. And if you're not comfortable sharing your own name, I would highly encourage it. It's a great show of like connection with your audience when you share your actual name. But say this is Chris here, founder of Slice Club, and I've spent years in the golf niche, and now I'm bringing that same slicer act, that same slicer spirit into our gear. That does not roll off the tongue at all. We just launched this many new designs straight from whatever inspiration you took for the collection, and they're designed for brand related descriptors, and only those who have blank, who have, bent a club in half, can truly appreciate, because you're part of our tribe audience, however you refer to them. You're getting first look before the rest of the scratch golfers. So, and then a link down here. So, overall, this is just a email template. Just copy and paste this into Claude and have it rewrite it for your brand, and just give it a general idea of the new 50 designs that you just launched to the site. And then you click to see the collection there. And the beauty of it is, notice that there's no graphics. This is what the actual email looks like. It's not bolded and there's no parentheses, obviously, but that's literally what it looks like. So here's an example for sloth. So new gear for people who hike at meditative who hike at a meditative pace. Hey there, Eric here from Sloth Hiking Club, the brand for people whose trail pace has sometimes been described as meditative by friends trying to be nice. We just released 22 new designs celebrating hikers who've never once said, let's push through, and whose favorite part of any hike is the part where you sit down. You're seeing these first. The fast hikers will catch up eventually. They always do. It's very annoying. Check out the new collection here. Happy trails, no rush. And then here's another variation. So you could send one like this, where it's just straight to the point, or you could add even more humor, like 22 new designs for hikers who get passed by grandmas. Fellow slowpokes, I'm Eric, founder of Sloth Hiking Club. I started this brand after getting passed on the trail by a guy in jeans and loafers twice on the same hike. That's when I realized I'm not here to set records. I'm here to look at the trees, eat snacks, and pretend the parking lot isn't that much further. So we just dropped 22 new designs for hikers who treat moderate difficulty as a loose suggestion and consider a bench sighting a legitimate trail highlight. And a side note here on these emails that we're sending, the KPIs we're aiming for refer back to the email training, but we're looking for the open rate tells us how good of a subject line it was, and the click through rate tells us how good of an email it was. So if you're not getting people opening, everything's progressive. You don't just try to fix emails generally. You analyze what numbers do I have access to and what are they telling me about it. So then we made 50 new designs. Then we send the email to the customers just saying, hey, we have new designs live on the site. Add some playful branding in here, and you can have fun with this. People love it. And that's what building like a real brand is. And you evolve on these conversations. It's like this is so much better than getting some generic, just like T Public type email where it's just like, hey, t-shirt, and it's just shirts in your face. Like there's nothing appealing about it unless if you're just a discount shopper. Anyways, so customer clicks on the email, and then step number 3 is they land on a new arrivals collection. So two different ways you can do this. What I recommend doing is just send people to the same collection we're driving all the traffic to. But what you do is you come in here and go date new to old, and then you copy this URL, because what this URL is doing, notice what it looks like now compared to if I go back to best selling. See how it changed this at the end? It's changing the URL. So when I leave this as new to old and then paste it in a new screen, we are directly linking people to the main collection sorted by the newest products, which is effectively creating a new arrivals collection for us. And the reason we're doing that is they are then going to see all the latest products sorted towards the top. And this is a great way to do a number of things. One, get easy free sales. And two, test out your newest products without ever having to put them in ads yet. And then step four is you identify the winners. You see which ones do people buy out of the email that you sent. And then step five is you put it into static ads. So the exact same static ad process that we talked about. Now we started off with the two sources of designs that we turn into statics is the ones that are getting cheap link clicks in the catalog and the ones that are getting sales. Now we're also able to add in which ones are getting sales from the emails, which you would still find that in the same spot. You just go to Shopify analytics and then product breakdown to see what's selling the most. And you run this for 2 to 3 days. So a Thursday to Sunday cycle. And step six is engage in the comments. This is something we didn't really touch on a whole lot. So I want to make sure we show this. So I go here to one of our ads, then click preview, then do Facebook post with comments. And here we're able to see all of the comments. Well, there aren't any right now, but we're able to see all the comments that are on the ad. And one of the highest leverage things you can do is come in here and just have fun replying to your customers or potential customers. So you come in here and you have fun. You can use the GIFs to reply to people. Just be yourself in the comment section because by doing that, you're showing people that you are, a real brand. You're a real person behind the brand, more importantly. And so, like, even when somebody comments and like tags a friend, just throw in a fun GIF or say, like it, heart it, show up and like be present in the comment section and it will yield a high ROI. I would not do that as like the first thing you do in the morning. That's more like, late at night type work when you got nothing else going on. But other things you might see is people engaging in the comments, giving ideas of products that you should create, which this then serves as basically product research straight from the horse's mouth. There's no better way to show your audience that you really care about them than by being in there, being present. And when people are commenting ideas, you show interest. And then you could take it a step further and actually go and create the design, especially with Nano Banana nowadays. Like if somebody said they want an alien hiker, it's really cool if Eric says, yeah, that's a great idea. It's even cooler if he says great idea and then 30 minutes later he comes back and says, "Hey, the design's live on the site," and posts a link. Not only is that awesome for that customer, but that's then an experience that like we have to keep in mind who else is watching. It's the rest of the hiking community. All the other potential sloth hikers are seeing this in the comment section. This is us compounding, getting the new restaurant opening line around the block type effect. Because once they see that, then you're going to get a lot of other ideas because people appreciate seeing that you're taking the time to engage. And then not only are you getting a bunch of new ideas, but then that engagement, Facebook loves seeing comments on posts because it's a sign that it's a good ad. And then they reward us with even cheaper ad costs. So it lowers Eric's CPMs and he's filled with new design ideas. And the total cost that basically out of everything that it costs us to do this is about $50 to $75 in ad spend. And an even better part about this is that we could very reasonably expect that these testing ads will perform better than the average because they're already been tested and validated. So we're only pulling in designs that got 1 to 2 sales at least from the email campaign that went out. So it's not even like we're just testing based off of link clicks. And so if you just rinse and repeat this process, like make 50 new designs, send an email campaign mentioning the new designs that just launched, and then like every other week, send some kind of discount or offer or time it up around a holiday. You should just have two different emails that you're sending per week. One of the best hacks for this, if you're not sure what emails to be sending, one, there's a great site called mild.com that is a giant library of email campaigns that have been sent from, yeah, Jesus, 46 million email campaigns from 102,000 e-commerce brands. So you should never be wondering what we should send again. Just come dive into this site. But you do this once email is your number one opportunity, as a side note. But basically, just rinse and repeat this. You make 50 new designs, you send an email on Thursday or Friday or Saturday mentioning the new designs are now live. Those emails always outperform anything else. And there's no discount attached. Costs us nothing. All that it costs us was being consistent with making the designs. And if you ever feel like you get stuck at this point, use all of your resources. Like, be as resourceful as possible. Using ChatGPT, using AI support should be a knee jerk reaction for you in this day and age. So, talk to ChatGPT, keep asking questions, and just stay curious. Just keep asking questions, not just of your peers or the coaches if you join the community, but asking questions of your metrics, asking questions of yourself, because that is where you learn the fastest. And just because something is not working does not mean that it's never going to. And this is where entrepreneurs are really made. This is where we have to push through. And of course, you can always get additional support. So you can join the 21-day challenge to jumpstart and go from zero, like no store, to your ads launched and getting feedback from the coaches on the performance. You can have the coaches review your store, look at your ads, look at your designs in a case study in the accelerator, and you can get essentially personalized guidance. But the biggest benefit of the community is the quality of all the people that are in there and how open minded everybody is. And a lot of times, what people need the most to get their business to where they want, from my humble experience, is they need to surround themselves with people that have the same energy and the same goals that they have. And as a side benefit, something else that really helps with this, at least for me, is being able to see other examples of what success looks like outside of just what we've talked about here. Like, just pull in as many references as possible. That's why we have what we call Funnel Fridays inside of the accelerator, where we break down like really successful multi 7 and 8 figure brands, going through everything from their customer journey to a brand analysis to reviewing all of their emails, their ads, their traffic sources, and we analyze all of this together so we can all learn as a community and then apply it to our brands. And we do this on there's so many different calls, like this call that we just recently had, the interview panel. This is where we bring in, I think the speaker yesterday, a student from the accelerator, just did $200,000 in December. He's in the accelerator. Full and undivided credit goes to the individual. Like, it is completely their win. And we are fortunate enough that they are willing to share their time with us to talk about basically how they got there. And it's not just like, look at my sales stats, like, look at me. It's really down to earth. And it's people asking them questions about, like, what was your journey like? What were the ups and downs? How did you get here? And then we're able to glean from their experience things we're able to apply to ours. And then we have the designated cohort calls for each cohort so that you're joining calls with people who are at the same stage as you. So now you have the complete system. And if you're not already there at this point, you should be well on your way on the path from 0 to 10K. And hopefully, the scaling protocol will help keep you focused on what is actually going to move the needle. And by making it this far in the course, you are truly, truly in the 1% of print on demand sellers. And now, before we call it a wrap on our time together, I first want to say thank you. Thank you for the time that you've spent with us going through the course. It truly means the world. And being able to work on this kind of project has been the most fulfilling thing that I've ever done. So, truly means the world to us. And I want to share with you where I go with my brands from here, like how we go from 10K to 800K. It feels like a really large leap, but in all reality, all that it is just rinsing and repeating over and over and over again the exact system. And you can study like some of the greatest founders in the world. Like, they are just ruthlessly focused on one idea for an extended period of time until it starts to pay off. Like, they are so ruthless, so disciplined about their focus on just one thing, one idea, one concept, that there's nothing that can possibly get in their way. They just stay laser focused on that and they do nothing else. So, your one idea to be ruthlessly focused on is the exact system that you just learned from top to bottom. So, you just keep repeating that. And now, even going through that, we touched on a lot of different areas. It's not to say that even through, the length of this course, that it's going to be 100% solidified. Every concept that we covered, crossing like the final mile to like fully understanding it and like true mastery, only comes from actually doing it and being in the trenches and experiencing it for yourself. And like all of the data driven decisions that we walk through, starting to make those decisions on your own and like starting to run your own tests and coming up with ideas for ads and new, like your brainstorming for design starts to take on different routes. That is where the magic really comes from. And so, whenever you feel like you hit walls, which does happen like all the time, I highly recommend referring back to the scaling roadmap, not just to diagnose what you should go and do next, and then you go and do it, but to learn the patterns, the pattern recognition of when I launch a bunch of designs, then my sales seem to go up. that kind of pattern recognition. And you do this by reviewing the scorecard exercise and make sure that you're running your financials on a daily basis. These are the most important skills that I can possibly impart on you because these were by far the most painful lessons for me to learn. Like I spent years running business like a chicken with his head cut off, just running around doing a little bit here and there, just constant firefighting mode, had nowhere near the system that we just walked through, where it's just follow that process. It checks all of the boxes. Not to say that it's easy, but it's dramatically simplified from how I ever operated before.